You think market crashes are random. You think the price of Bitcoin drops because retail investors get scared and decide to sell all at once. You watch the news, you read the headlines, and you believe the narrative that digital markets are just volatile and unpredictable. You are completely wrong. Right now, a single institutional margin call can trigger a $40 billion liquidation event in less than an hour. And the worst part is, the traditional banking system engineered it this way. Today, I am going to show you the exact hidden mechanism that Wall Street uses to force these crashes. It is a mathematical trap designed to shake you out of your position, drain your net worth, and transfer your assets directly into institutional vaults. In the next few minutes, we are going to dissect the clinical anatomy of the death spiral. You are going to see exactly how debt poisons decentralized assets. You will understand why the market always seems to crash the moment you feel the most confident. Pause and write this down right now. Volatility is not an accident. Volatility is a weapon. If you do not understand how algorithmic liquidation works, you are playing a rigged game blindfolded. The great illusion of the modern investor is the belief in pure supply and demand. You assume that if a technology is good, the price goes up. If the technology fails, the price goes down. But that is retail psychology. That is how the 99% think. The 1% do not care about the technology. They care about leverage. Let us look at the invisible architecture of a market crash. It does not start with a bad earnings report or a government ban. It starts in a quiet boardroom months before the crash happens. Massive corporate entities, hedge funds, mining companies, and institutional trading desks want to accumulate digital assets, but they do not want to use their own cash. That would be too slow. So, they go to the traditional banking system. They take out billions of dollars in corporate loans using their existing crypto holdings as collateral. They inject this borrowed money into the market. The massive influx of capital causes the price to skyrocket. You look at your portfolio and see 50% gains. You think you are a financial genius. You think mass adoption is finally here. But you are ignoring the trap being set right beneath your feet. You are celebrating debt, not value. When you buy an asset with your own salary, you own it outright. You can hold it for 10 years, even if the price drops by 80%. You have staying power. But when an institution buys $1 billion of Bitcoin using borrowed money, they do not have staying power. They have a strict mathematical leash held by a traditional bank. When the market drifts down even slightly, maybe just 5 or 10%, the value of their collateral drops. The banks, acting as ruthless risk managers, automatically issue a margin call. They demand more cash to secure the loan. If the institution does not have the cash, the bank's automated trading engines do something brutal. They seize the digital assets and sell them on the open market at whatever price they can get. They do not ask for permission. They do not wait for the market to recover. They liquidate. This is the exact moment the death spiral begins. When an automated banking engine dumps hundreds of millions of dollars of an asset onto the market in a matter of seconds, it destroys the order book. The price instantly plummets another 10%. But here is the catastrophic hidden reason why the crash accelerates. That sudden 10% drop triggers the margin calls of other heavily leveraged institutions. Now, 3 more funds are forced to liquidate. Their automated selling pushes the price down another 15%, which triggers even more liquidations across the globe. It is a domino effect of forced selling executing at lightning speed by algorithms that have zero human emotion. The asset itself is perfectly fine. The blockchain is functioning. The code is flawless. But the price is in free fall because of a structural debt collapse happening entirely behind the scenes. This is the liquidation trap, and you, the retail investor, are the ultimate victim. Let us look at your psychology during this event. You wake up at 6 in the morning, check your phone, and see a sea of red. Your portfolio is down 30%. You feel a physical knot in your stomach. The cognitive dissonance is deafening. You start frantically searching Twitter, Reddit, and financial news sites looking for a reason. You need someone to tell you why this is happening. But the news outlets do not understand the liquidation engines either. So they invent narratives. They blame a tweet from a billionaire. They blame a minor regulatory rumor. They feed you noise. And because you do not understand the hidden mechanical truth, you believe the noise. Fear overrides your logic. The pain of watching your net worth evaporate becomes too much to handle. You convince yourself that the asset is going to zero. You hit the sell button. You sell your position at a massive loss, swearing you will never invest in digital assets again. You just fell perfectly into their design. While you are panic selling at 3 in the morning trying to stop the bleeding, who do you think is on the other side of that trade? The institutions that held cash, the smart money. They understand the death spiral. They know that forced liquidations push the price far below its fundamental value. They watch the leveraged funds get wiped out, they watch the retail market panic and dump their coins. And then, when the blood is in the streets, they quietly step in and buy your assets at a 40% discount. They did not create the technology, but they mastered the psychology around it. They used the invisible weapon of debt to shake the tree, knowing that the 99% will always drop their assets when the branches shake violently enough. Your emotional reaction is the exit liquidity they rely on to build generational wealth. You cannot stop the traditional banking system from issuing margin calls. You cannot stop over-leveraged hedge funds from getting liquidated. The system is operating exactly as it was designed to, but you can completely immunize yourself against it. The protocol to survive the liquidation trap requires a fundamental rewiring of how you perceive a crash. Rewind this and listen closely, because this is how you separate yourself from the herd. The next time you see a violent 30% red candle on the chart, you must stop looking at the price and start looking at the mechanics. You must ask yourself, did the fundamental value of this network change overnight? Or is a massive entity just getting squeezed by their lenders? The data proves it is almost always the latter. Stop reacting to someone else's margin call. When you understand the hidden reason behind a crash, the fear evaporates. You stop seeing a market collapse as a tragedy, and you start seeing it for what it actually is, a massive, automated transfer of wealth. If you own your assets outright, with zero debt, you hold the ultimate power. You have the privilege of patience. You do not sell into the panic. You recognize that the highly leveraged players are being purged from the system. You sit on your hands, or better yet, you deploy your own liquid reserves to buy the deeply discounted assets that the terrified retail market is abandoning. While the average person curses the market and accepts a permanent loss, you recognize the mechanical pattern. While the 99% surrender their wealth to the algorithms out of pure emotional exhaustion, you stand firm. That is not just financial literacy. That is psychological dominance. And it is the only way to survive in a market entirely controlled by institutional leverage. If you want to master the true psychology of wealth, expose the systems designed to keep you broke, and stop acting as Wall Street's exit liquidity, subscribe to this channel. The elite rely entirely on your lack of understanding. Choose your game.